Hello everyone, welcome to Module 7 of Sanction. Until now, we have discussed what sanctions are, how screening works, and how sanctions can be evaded. In this module, we will understand what happens when sanctions rules are violated. Sanction breaches are not treated like small operational mistakes. They are considered serious legal and regulatory failure because sanctions are linked to national security, terrorism prevention, and global peace. This module explains the real world consequences faced by banks, companies, and individuals when sanctions are ignored or mishandled. So, what is sanction breach? A sanction breach occurs when a bank, company, or individual directly or indirectly deals with the sanctioned person, entity, country, or activity in violation of applicable sanction laws. A breach does not always require intention. Even unintentional or negligent actions can be treated as a violations. Regulators often say that sanction compliance is a strict liability area, meaning that lack of knowledge is not an acceptable excuse. For example, if a bank processes a payment for a sanctioned entity because screening controls were weak, the bank is still responsible even if there was no intention to violate the law. This is why sanction compliance focuses heavily on controls, systems, and governments, not just intent. On financial penalties and monetary fines. One of the most visible consequences of sanction breaches is financial penalties. Regulatory authorities can impose heavy monetary fines, multimillionaire or even billion-dollar penalties. These fines are not symbolic, they are designed to punish non compliance, deter future violations, send a message to the industry. For the large banks, fines may run into hundreds of millions of dollars. For smaller institutions, even a single fine can threaten survival. It is important to understand that penalties are often calculated based on number of violations, duration of the breach, level of negligence or quality of internal controls. A bank with poor system and weak oversight will face harsher penalties than a bank that made a genuine error but had strong controls in place. Now, business restrictions and license consequences. Sanctions breaches can also lead to business restrictions. Regulators may restrict certain business activities, prohibit international transactions, and limit correspondent banking relationships. In extreme cases, authorities may suspend banking license or revoke authorization to operate. For banks, losing access to correspondent banking relationships, especially in major currencies, can be devastating. Without these relationships, a bank cannot operate globally. This consequence is often more damaging than financial penalties because it affects the future ability to do business and not just past mistakes. Now, criminal liability and personal consequences. Sanctions breaches can also lead to criminal liability, especially when violations are intentional or involve willful misconduct. In such cases, senior executives, compliance officers, or employees may face criminal investigations, prosecution, or imprisonment. This is an important point to explain clearly that sanction compliance is not only a corporate responsibility, individuals can also be held personally accountable. Even junior employees can face consequences if they knowingly ignore red flags or deliberately bypass controls. That is why compliance professionals are trained to protect yourself by following procedure and documenting decisions. Next is reputational damage and loss of trust. Reputational damage is one of the most long lasting consequences of sanction breaches. When a sanction violation becomes public, customers lose trust, investors lose confidence, and business partners become cautious. Reputation once damaged is very difficult to rebuild. In many cases, banks that pay large fines suffer drop in price, increased regulatory scrutiny, loss of competitive advantage. Reputational risk often extend beyond the institution to senior manager, members, or compliance leaders. Next is regulatory scrutiny and long term impact. After the sanction breach, regulatory scrutiny does not end with a fine. Banks may fine ongoing monitoring, independent audit, and mandatory remediation programs. Regulators may require system upgrade, staff retraining, or policy overhauls. This increased oversight can last for years and consumes time, resources, and management attention. Even after penalties are paid, the compliance burden increases significantly. Now, lessons learned from sanction breaches. The most important lesson from sanction breaches is that prevention is always cheaper than remediation. Strong controls, proper training, and a culture of compliance can reduce risk, protect employees, and protect the institution. Banks that invest in compliance are not being overly cautious, they are being strategic and responsible. Sanction compliance is not about blocking business unnecessarily. It is about ensuring that business is conducted within legal and ethical boundaries. So, in this module, we learned that sanction breaches have serious financial, legal, and reputational consequences. Even unintentional mistakes can result in heavy penalties. Sanction compliance protects not only the bank but also its employees and the global financial system. A strong sanctions framework is not a cost, it is a risk management necessity. With now, we complete our module 7. Thank you.